Hello and welcome to SwitzerTV Investing. I'm Peter Switzer, and on this special program tonight I've asked 7 experts, including myself, to pick out one company that they think has done well out of reporting season and is worth investing in going forward. We've got Julia Lee from Birmingham Invest, Rudi Filapek-vandyck from FN Arena, Michael Wayne from Medallion Financial, Michael Gable from Fairmont Equities. Then we have Tony Featherstone from the Switzer Report, Paul Rickard from the Switzer Report, and of course, I've got to stick my neck out and select a company as well. Then I go head to head with the CEO of one of the best companies in Australia, NextDC. This company has done really well because of the coronavirus, but I think its future is well ahead of it. It's basically an infrastructure company based on the cloud, and Craig Scroggie, the CEO, is a very, very interesting guy. That's the show for tonight. Without any further ado, let's cross to Julia Lee. Well, my first expert off the rank is Julia Lee from Birmingham Invest. Julia, I've asked you to find the stock that you like as a consequence of reporting season, so take it away.
I choose Mesoblast. Probably doesn't come as much surprise. And I guess Mesoblast is a biotech company, and generally these biotech companies, they're almost like adult children where they go back to the parents and ask for a huge amount of cash, and you almost become an ATM. But at some point, hopefully there's an inflection point, and with Mesoblast, it's at that inflection point where it has a number of products which are pretty close to commercialization. So either in phase 3 or awaiting a decision from the Food and Drug Administration to sell its product into the US. The nearest one is for acute steroid refractory graft versus host in children. And this is due for a decision before the 30th of September this year. So if it does get approved, they'll be selling their product in 2020, which is pretty exciting. And of course, there are a number of other products in phase 3 as well. One for chronic heart failure, which is also in a phase 3. It's also looking at of course, COVID-19 and the ARDS as well in children and in adults. And we're due to get an interim report on that anytime, any day as well. So look, I think Mesoblast, plenty of catalysts there. And I think in terms of the results that we've seen, we did see revenue up by 92%. Revenue for Temsa was up by 32%. And I think that 2021 is going to be a blockbuster year if it can get another product in commercialization.
So Julia, is this what you would call a speculative play in the short term, but more a reliable play in the longer term?
Look, it's speculative, but it is de-risking quite rapidly. For example, graft versus host in the US, that's up for decision on the 30th of September. It went to an oncology committee first, and there was a vote out of 10 members on whether they would vote for the drug or against the drug, and 9 out of the 10 voted for. And usually the FDA takes the side of the committee, so it isn't bound by that decision, but it certainly does listen to that committee. So these type of things de-risk the investment as we go along, and of course if the green light is given, that would be a huge catalyst in terms of the business and share price.
Okay, Julia, I won't pester you much this week because we've got 6 other experts doing their best stock, but it's great to talk to you, and we'll talk to you next week.
Sounds good. Thanks, Pete.
Joining me now is the founder of FN Arena, Rudi Filapek-vandyck, and he nominated a particular stock that he likes from reporting season. Take it away, Rudi.
Well, Peter, I'm always glad to be here. Always good to see you. I think I pick a stock that not too many people would think about. I can sort of see the challenge for investors this year, since we have a lot of companies who are no longer paying their dividends, and a lot of people would be looking around and go like, where do I go? I think there are a few companies in the share market in Australia who could be regarded as dividend champions, in that they are very, very, very unlikely to cut their dividends, and most likely they will increase their dividends year in, year out. And one of the companies I've selected in this regard is Charter Hall Long Whale REIT. And whale is not like the fish, it's W-A-L-E. And I mean, people should do their research, of course, but my view is supported by the analysts who cover this sector of the REITs, and they all regard this as a standout quality exposure.
You'll be happy to know that your old buddy Julia Lee has been talking this up for a few weeks as well. And when
Damn it! I thought I was original here.
Yeah, and when you two coincide or coalesce, it's often a good pointer. Explain to my viewers what WHALE stands for, because a lot of people are worried about REITs, but this is one REIT that a lot of people are giving a tick.
Yes, it's essentially instead of going through a lot of very difficult terminology now, essentially, if you are a landlord and you have different properties, then the average lease you have on each property is being calculated, and that means that investors know when most properties come up for renewal for the lease. And in this case, that's what WHALE stands for. It's the weighted average liabilities and so forth.
Yeah.
But investors should know it's very long.
Yeah,
in
long.
This case, it's very long, and that's very good because that means stability.
Yeah, and they have big clients as well, so they're not exposed to the small retailers that might be getting rental exceptions, mate. I'd love to talk to you longer. We will in the future, but I just want to concentrate on your one stock. Thanks for joining us in the program.
Pleasure.
My next expert to look at the stock he likes as a consequence of reporting season is Michael Wayne, the founder of Medallion Financial Group. Well, Michael, take it away.
Yeah, so look, it's been an interesting reporting season, but the stock that we thought reported the best was a company called Megaport. Essentially, this is a business involved with data centers and data storage. It offers network as a service, so similar to software as a service, but offers access to a network for very large companies looking to store their information and basically access multiple cloud databases from one portal. It's a business that's really emerged in recent years and has pushed on up towards $16 after only being, around the $3 mark a couple of years ago. But very large clients such as Salesforce, such as Amazon, very scalable model as well. So it's a company that we think is going to benefit from this thirst for data and this working from home environment we find ourselves in.
So you think in many ways what we're seeing, this working from home inclination of society, is actually going to be a plus for Megaport?
Yeah, well, they estimate that the database market by 2025 will be a $25 billion US market or industry in basically 5 years' time. And Megaport's in the prime position to capitalize on that. It's in many ways the first mover in that space, and they offer a technology that no one else can compete with at this point. So they're in a very good position. They've recently launched a new product as well. And the way that we sort of look at it is it's a bit like a roundabout in that you can choose when you want to get off and when you want to get on, despite the fact that different databases, different cloud data sets might have different support networks. Megaport essentially allows different forms of data to be sort of accessed at once. So we think that it's a business, a new age business that will benefit from the repeat business, and also the customers that use Megaport can decide when they need access to certain systems and certain data at different times. And that flexibility, I think, is a real attraction for the company.
Michael Wayne, thanks for joining us.
Thanks, Peter, for having me.
My next expert to look at the stock he likes as a consequence of reporting season is Michael Gable from Fairmont Equities. Michael, thanks for joining us.
Thanks, Peter.
Good to see you in the flesh.
Good to see you too.
Not Zoom like everybody else in the world. Now, you like Goodman Group, GMG. Tell us why.
Look, we've liked Goodman Group for a while, and I think if you're taking a 12-month view, it's a fairly easy stock to go for. I know that there are a lot of other exciting stocks out there, the tech space, you can make some fantastic returns dabbling in that. But I thought if you've got 12 months, you don't want to ride a lot of volatility, and you just want to stick with this particular company as a long-term hold, then I don't think you can go past Goodman Group. So
tell us why.
Well, they're the best REIT. So I think in that sector, Goodman Group's proven to be the best.
And
That's
REIT
the
is a
lowest.
real estate investment trust for people who
Yeah.
aren't experts like you.
That's right.
And a lot of REITs are unpopular now because landlords aren't getting rents. Why are these guys so good?
Well, the good thing about Goodman Group is they're exposed to industrial properties. So
Warehouses and stuff.
Warehouses. So everyone's buying things online. That stuff
Yep.
needs to be stored somewhere.
Yeah.
And that's in a lot of these properties. So I can understand that in the property sector, you know, the retailers are doing it, well, bricks and mortar retailers are doing it tough, and there's a number of other sectors, office space doing it tough. But industrial property is doing pretty well. Goodman Group has very low debt. They grow their earnings quite nicely. So during reporting season, they grew their earnings by just over 11% for the year. They always sort of under promise, over deliver. And I can just see this company not only being resilient in the current environment, but when the economy picks up again, it can only do them favours.
Okay, and tell us what's good about the chart that they're seeing it's heading in the right direction, but what's so good about it?
So the good thing about this particular chart is just the lack of volatility. So as you know, like most stocks, it took a big hit in February, March.
Yeah.
But if you ignore that price action, you can see that it just steadily increases over time. No nasty surprises. And basically what that means is it's the type of company that you just buy the dip. So if you see any sort of dip in Goodman Group, it usually only lasts a short period of time and then it just continues on its merry way. So I think for the investors out there that don't, you know, they're happy to bypass the excitement of the tech sector.
Afterpay and Zip and whatever.
Exactly, and they're just looking for something long term. 12 months from now should deliver a return without any nasty surprises. I think Goodman Group's one to look at.
Solid, honest John type stock, but it's still linked to the future, isn't it? It's online sales.
Exactly, and I think that you know that's the big key going forward is the stocks that will benefit from the resurging economy, and Goodman Group will benefit from that as well.
That's Michael Gable from Fairmont Equities. My next expert to look at the stock he likes as a consequence of reporting season is Tony Featherstone from the Switzer Report. Tony, take it away.
Pete, the stock I like after reporting season actually is not really because of reporting season, and it's Qantas, because the fact is I don't think you can read too much into Qantas's profit right now, given everything that's been going on. It's a big call, I think, to be keen on travel, tourism, leisure type stocks at the moment, because they were the first affected and they'll be the last to recover, no doubt about that. Worldwide and in Australia, we've seen airlines that have been grounded, borders shut. The industry's just a basket case. But if you look forward, if you go forward a year, I think things are starting to look interesting for Qantas. I'm not saying there's going to be a massive recovery in travel demand. I actually don't believe that. I think a lot of us will be Zooming and doing our meetings at home, and fewer people will want to travel. And I think the international travel story recovery will be protracted. It's not going to recover anytime soon. I think Qantas, though, really to me is a micro story. So when we get out of this mess, and we will, when we get out of this mess, I think Qantas will have a vastly weakened competitor in Virgin. Qantas will be streamlined and stripped down. They're taking $1 billion out of cost to the business, strong balance sheet, and I think there's huge untapped value in Qantas through its frequent flyer business. I think that's an interesting business at all times, and especially now with this interest in digital payments and digital financial technology. So I think when the market picks up, it's a long-term recovery story. I think Qantas is in a much stronger position.
And someone like you, Tony, who's been watching markets for years, there is an argument that you go for quality companies when there's blood in the streets.
Oh, of course. And look, the number one thing with Qantas is after its capital raising, it's cash. It's got plenty of cash. It'll survive this crisis. It's well run. It's well governed. Has been for a long time. High quality company. Airlines normally have had lots of problems. Even the great Warren Buffett has got it wrong of late in investing in airlines. But Qantas is a really good company, and it's going to get even better, but the recovery will take a while.
Tony Featherstone, thanks for joining us.
You're welcome, Pete.
Our penultimate expert, of course, is Paul Rickard from the Switzer Report. And Paul, tell us what stock you like and why.
Peter, I've nominated CSL, a bit boring, Australia's biggest company, but I think it reported pretty well and it still justifies the mantle of being Australia's best company. Look, it's got a couple of headwinds at the moment. The two headwinds are the currency, and that doesn't help. And secondly, look, some concern about the plasma collection in the US. Obviously, it gets most of its plasma from the US. It gets it out of poorer suburbs. The lockdowns.
And people get paid
who get paid to actually donate blood, and that has impacted its ability to collect plasma. And it's taken on some extra cost to make sure that they're safer when they come inside, the way that people see, just like any other company going through some COVID-19 shocks. But I think those costs are temporary. It's putting more in next year into R&D. It's got upsides in terms of the vaccines, or in terms of COVID-19. One upside with the vaccine, to do with treatments. And these could all be winners for CSL. So apart from everything else, the fact that year in, year out, it keeps on delivering. Next year's guidance looks okay. Look, I think it's a great stock to be in the portfolio. So I think it deserved to go up after the result. Come back a bit since then because of the currency, but I think people in due course will go back to CSL.
Yeah, and its former high was around 330 or something?
Yeah, look, got to about $340. It's sort of found a base, I guess, at about 270. It's around about the 290 at the moment, give or take a bit. Went over about 305 after the results come back a bit, but I think people will come back to it. And this company has shown it can grow year in, year out. And if you actually look at the metrics, it's not that expensive now. So I think that the market will come back to it.
And it's interesting that Tony Featherstone, in his little piece to camera, was saying that a great time to buy quality stocks is when there's blood in the streets. And there's blood in the company called CSL.
Well, there is blood in the streets. And of course, look, we are seeing this enormous movement of things like the buy now, pay later stocks, which the valuations are just stratospheric. Doesn't mean that Afterpay won't go to 100 and 110, who knows where it goes. I've been wrong on that. But at the end of the day, at some stage, they'll be held to account to deliver the earnings that are built into their share price. And I think people will come back to CSL. So that's mine, and I'd be happier. This company has a 25-year record, and I'd rather back the 25-year record than some of the other companies out there. Call me traditionalist if you like, Peter. Maybe stick in the mud, but I think it's a great company.
You're definitely a stick in the mud, Paul, but you're our stick in the mud. That's Paul Rickard of the Switzer Report. And my final expert is me, and the company I like is Elmo Software. Yep, I have a holding in it, not a real lot, but I think it's a company of the future. Its share price is up 172% in 3 years. It's an HR and payroll business online in the cloud. It kind of has that feel a bit like Xero, which is primarily a bookkeeping business. Its gross profit margin was up 85.3%, which is pretty good. New customers up 25.4%. The average use of modules, they basically sell modules to business. The average one is 2.7, but the average new customer came on has 3.9 modules, so there's good improvement there. I also still think this is a company that's going to go well in the future. The guy who put me onto this company was Michael Wayne from Medallion Financial. I contacted him today. He still likes the company. He's talked to the company after reporting season. So this is a nice speculative company in the right space, namely cloud computing and also linked to business. And when you consider it at the moment, a lot of business will be cutting costs because of all the fears around the coronavirus. I think going forward, this could be a really, really interesting company. Now, coming up now, after the next break, is the CEO of NextDC, Craig Scroggie. This is an interview you don't want to miss if you want to invest in the future.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Craig Scroggie, welcome to the program.
Thanks, Peter.
NextDC, it's a company I've always admired, Craig. Unfortunately, I haven't invested in your company, which is one day I'm going to change that. And every time I jump off a plane and go to Melbourne, which you can't do nowadays, I'd see that big NextDC building as you're coming over the Balti Bridge, and I kept saying to myself, these guys, how do they fill these things, and what are they doing in there? But you've certainly shown over the most recent time that people are using a lot of NextDC product.
Yeah, Peter, good news is that it's only really the very beginning. We're only a decade old and you haven't missed the opportunity yet. So don't waste any time. Get in there into the stock today. Okay. My favourite saying, I reflect on it regularly, and that is that given we are building an infrastructure business, Bill Gates is famous for saying, people almost always overestimate what they can achieve in a year and underestimate what they can achieve in a decade. And if you look at the business's journey from a startup 10 years ago to today, more than 200 million in recurring revenue, over 100 million in EBITDA. We've invested over $2 billion in facilities around the country to build this digital platform that supports the growth of the largest public and private clouds in the world, the Microsofts, Amazons, Googles, IBMs of the world, and then also supporting thousands of enterprises and governments in Australia. So it's been a great journey, but Peter, it's really only just beginning. Yeah.
But Craig, it's always staggered me because at the end of the day, it looks like you just get massive factories, old factories, and just throw a whole lot of equipment in there that means that we all can use the internet. That's what it seems like you've done. Why didn't Telstra do it? It seemed like it was their natural game they should have played.
Look, it's a really interesting question. And I think that if you look across the world, Peter, at telecommunications providers, many of them started in data centres for peering, handing off of traffic between networks. But very few of them today are actually in the data centre industry, and it's because network neutrality is a critically important element of an enterprise data centre. Customers want to be able to host their infrastructure in a neutral location and then take advantage of a multiplicity of network and cloud service providers. So the role that the data centre plays is a very neutral one in relation to accessing public and private cloud computing. It's also importantly where you can get a very diverse set of services provided to you by telcos. So Telstra are not alone in the context of many of the other largest telcos in the world. AT&T, Verizon and others have not been in the hyperscale data center business today. So I don't think they're unique. They're generally not old sheds that we build, Peter, but brand new ones, because floor loading, energy efficiency, the volume of power. 10 years ago, a large data centre used to be 10 megawatts, and today in our third generation in Sydney and Melbourne, they're getting up close to 100 megawatts. That's in excess of $1 billion worth of infrastructure in each building. They're highly customised, extremely energy efficient, and that's ultimately what's providing all of that cloud for us.
Craig, what I've noticed over the years, I was looking at your chart today, that you go up, then you go sideways for a while, then you go up, you go sideways for a while, and it's that sideways bit that probably has thrown me a little bit. Your last move has been up. You don't look like you even had a coronavirus slump of any kind. So could some people be therefore thinking, okay, they've had their spike, they're now going to go sideways. Is this when they're actually building more capacity that costs money, therefore the market doesn't like them for a while they're forking out lots of money to get new sheds? Is that what actually happens here because you are an infrastructure business?
It's a good description, Peter. I tend not to, I can't explain why the share price goes up or down. Sometimes it goes up, sometimes it goes down. What I can explain is ultimately the underlying economics behind the company. So just a couple of key points. And I think your statement is fair, but it is an infrastructure business. So we need to invest the capital up front. It takes a couple of years to develop a site from new, and then it takes 5 years on average to fill. Sometimes we fill quicker than that. But generally, if you look at our first generation of facilities in Sydney, Melbourne, they've got about $150 million worth of plant and equipment in them. Today, After 5 or 6 years, those facilities now produce about almost 50 million in EBITDA on an annualized basis, which means they're returning their plant and equipment capex every 3 years. So sometimes the price goes up, sometimes it goes down, but really for us, if we look at that company performance over the last decade, we're building an infrastructure business. We've gone from a startup, genuinely building. We've never bought anyone else's data center business. We've built the data center operation organically now, 10 data centers in the ASX 100, over $5 billion market cap today. So I think it's just a consistent journey of patiently building infrastructure. Sometimes price goes up, sometimes it goes down. But ultimately, as long as we focus on the overall return on invested capital economics, we'll continue to build a quality business.
Okay, so if I was running JB Hi-Fi, I would be looking at things like disposable income, the new pipeline of technology that will make people run and buy this sort of stuff. When it comes to you working out the demand for what you supply, it seems to me it's going to be the growth of the cloud and the businesses using the cloud that probably currently aren't there or will be magnifying their use of the cloud. What is your crystal ball telling you about the pipeline for demand for cloud type services / products?
Yeah, Peter, the underlying exercise we've just been through, if you think about 2020 as a year, we started the year with 1 in 100 year bushfires. We then, in late January, early February, had 1 in 100 year floods. And then just to cap it off, if we hadn't already had challenges, we decided to throw a global pandemic on top of that and get a hat trick of 1 in 100 year events. Essentially, that caused us then to go into what has been the single largest work from home experiment in the history of our lives. And that has caused a decentralisation of work and school. And really that underlying demand forced everybody to get with the program of adopting remote working technology. So whether it was Zoom users, Microsoft Teams, frankly, anything in a business context, we've seen very, very strong demand for users adopting those enterprise class technologies. The other thing is on the consumer side, the hardest thing many people had to do was go home. They were forced to not only work from home and school from home, but just stay home and stay safe. And that caused them to consume more Netflix and other on-demand services, gaming and other things that we've seen in a network context boom from home. So really the two key drivers of demand for us, Peter, is that change in working conditions caused people to need more infrastructure support. So our big customers had to provide more services for the enterprise. And then we've got enterprise customers who used to run their data centers on premise. More than 70% of the market today still runs its data center in an office. And over time, that's one of the single largest opportunities yet to come. It hasn't even really started yet.
Yeah, okay. So to me, you're telling me the long-term story for NextDC is terrific because we will progressively go on the cloud. And I think a lot of people who sampled online buying will keep on doing it even when they go back to the office. But here's my question to you. If a vaccine turns up and normalcy comes on by the middle of 2021, yep, would you expect maybe the usage of your stuff to come off the boil a bit because of that?
Well, I think that, Peter, we've actually had an accelerated change of the way we work and live. I don't think people are going to go back to what it was previously. For most of us, who had spent our lives traveling for work, it wasn't that we didn't think meetings were not necessary, but we probably became accustomed to doing things because that's how we did them previously. There is no question that we are doing more work. There's a great description used to describe network capacity today relative to 10 years ago. After broadband and before broadband, today we have the capacity to do the majority of what we need to do remotely. So I don't think that we'll go back to traveling the way we did or frankly working the way we did previously. And we've dragged a large number of laggards who wouldn't have come kicking and screaming had they had no other option into the modern world. And I think that ultimately means that we've reset the base at a higher level, and that will drive an even further acceleration of the adoption of digital technology.
So therefore the contrarian play would be put half your investment into Qantas and half into NextDC.
I'll leave the stock picking up to you, Peter.
All right, Craig Scroggie, thanks for joining us on the program and good luck going forward, mate.
It's great to see you. Thanks, mate.
As I said, that interview with Craig Scroggie, this is a guy who's looking at the future. His business is completely leveraged to that future. That's the show for tonight. Thanks for joining us. I'll see you next week.